I actually try to like just never use the word ROAS by itself because I think this is where it starts to get like impossible to communicate properly. So at Aplo, we tend to default to new customer ROAS, full funnel ROAS, or like definitely it's a Facebook ROAS. I said 7-day click ROAS, 7-day click, 1-day view, 1-day click. So basically, like, anytime we use the word ROAS, we try to make sure we make it abundantly clear what we are referring to.
Yo, episode 11. Let's go. Dylan, what's cracking, man?
Not much, not much. It's a busy week for me. I'm heading on a trip on Wednesday.
Awesome. I'm actually heading on a trip, family vacation on Thursday as well. So I've got
Let's
to
go.
coming off an in-person event, the Final Loop event. That's why if you're watching this on YouTube, I got my finance hat on my Final Loop branded finance hat. Um, so I'm like ready to go to talk about what are we talking about? Common ecom metrics. What are they? When to use them? I thought it would be cool for us to talk about this because I'm sure, or I'm curious to get your take, but from my vantage point in the space, there's so many different acronyms. Whenever we have hired someone at Guardian Bikes who hadn't been in ecom before, the feedback I used to always get from new employees is like, dude, there's so many acronyms in ecom. I got no idea what the heck you guys are talking about.
We could just ban all acronyms and just this podcast is done. And we don't have to worry about it.
and so not only are there a bunch of acronyms, but I actually find, and I think more importantly, I find these metrics being defined differently depending on who you talk to, oftentimes. So conflicting definitions and misapplication of when to use them. So we're just going to go down the list of several common ecom metrics, define them, and just have a bit of a discussion about like when to use them and really what they measure. So I gotta start with the banger. ROAS.
What
Dylan.
is my ROAS? That's a
Yeah.
common question. Oh well.
What
What kind of ROAS we talking here? Uh,
so what when
uh,
if a client or a brand is like, hey, Dylan, what is ROAS? Like, how do you define ROAS, the acronym, and what does it mean?
I actually try to like just never use the word ROAS by itself because I think this is where it starts to get like impossible to communicate properly. So at Aplo, we tend to default to just always using the word new customer ROAS, full funnel ROAS, or like insert here ROAS. And that would be like your Facebook ROAS, your triple whale X, whatever attribution model ROAS. In definitely it's a Facebook ROAS. I said 7-day click ROAS, 7-day click, 1-day view, 1-day click. So basically, like, anytime we use the word ROAS, we try to make sure we make it abundantly clear what we are referring to. So in terms of like the most common ROAS metrics we talk about, so in platform is one, and oftentimes we're going to make sure we clarify which attribution setting that includes as well. Um, Full funnel is all revenue divided by spend, which is also some people call MER, which we'll get to at the next list. And then there's new customer ROAS, which is just new customer revenue divided by spend. And then there's third party tracking ROAS, whether you're using Triple Whale, Northbeam, Wicked Reports, whatever. That's another type of ROAS. So when we're using those metrics, we're just making sure that we're defining clearly which one we are referring to because there's so many ROASs. There's almost too many.
So that's a hat right there. Too many ROASs. What about wait? So is returning customer ROAS undefined because it's divided by zero? I'm just kidding. Um,
That's actually a great point. So technical here. So um, for a lot of the brands we work with at Aplo, whether you're like, like mid 7 figures, getting into 8 figures, getting into mid 8 figures, oftentimes, depending on your revenue makeup, it is just more productive and easier to, in our opinion, when you're allocating ad dollars against the revenue source, just allocate it against new customer. And then over time, you might have to start stripping out how are my ad dollars impacting return customer revenue. But for many brands, that is like not a worthwhile exercise. And it is often going to be a less accurate exercise due to how attribution actually works. So That gets into like how you measure in general. I think we should stay away from that for the purpose of
For
staying
sure, for
on
sure.
track here.
There's a
But
debate, but just so you know, there's an internal debate at Free to Grow CFO with our CFOs about this. Not we do allocate all ad spend like you guys to new customer sales, but like I feel like once a month someone brings this up because a client brought it up to them, and we get into this long drawn out philosophical conversation about like, is the juice worth the squeeze to allocate ad spend, some amount of ad spend to returning customers? And then even if it maybe is worth the squeeze, at the end of the day, philosophically, shouldn't we think about our ad spend as mostly needing to drive new customer acquisition anyway? So anyways,
yeah,
I'll save that. Maybe that's a
there's
different episode.
so many thoughts, but we won't
I
do
know, I know.
it.
Okay, well, that's another episode. We're gonna have to put that on the list. Okay, so a couple of things that you mentioned. One, I was immediately drawn to when we first started working on mutual clients. I was immediately drawn to how I noticed right away you and your business partner Liam would say full funnel ROAS, right? Um, that was the first time I had ever heard that term. And like, I mean, shamelessly, I stole that from you guys and I use it all the time now because it's just descriptive. But the point I want to make is all those things that you mentioned: new customer ROAS, full funnel ROAS, in platform ROAS, third party tool ROAS. The point is it specifies, well, and then you said like 7-day or whatever. You're specifying a location, right? A location being a sales channel or a platform that is measuring it. And then you're also potentially specifying a time horizon. You're making it time bound. And so I think that's the major takeaway for people listening is like, if someone says, hey, what's my ROAS? Your follow-up question should be, which ROAS? Full funnel, new
Yeah.
customer, in platform, some other. So ROAS alone is incomplete. It's actually like saying, and maybe this forces us to segue to these metrics, but LTV, you can't say LTV without making it time bound. Is it the 30-day LTV? Is it the 60-day LTV? The 90-day LTV? But we'll say it's
We may have a term because I think that caliber should be like, what is your 30-day customer value or like your 1-year customer value?
sure. Yeah.
Lifetime. The acronym doesn't make any sense. And this is why
No, that's true. That's true. Saying 30-day lifetime,
yeah,
right?
it's like wow.
Yeah. That is a good point that I've actually never thought of before. That's that's classic.
I think I got asked that once because someone was confused talking. I'm not sure if they were in an ecom. I don't know. And I was like, that's a good point. Like, why do we say this?
I mean, obviously it's for the lifetime of that cohort, but when it's
Yeah.
confusing, right? It's like
Yeah.
it's super confusing. Okay, so I do want to talk about LTV, but I think we have to talk about MER next, just because of the connection to ROAS, and you already
Yeah.
mentioned it. So, uh, marketing efficiency ratio, MER. How do you guys define it? Do you guys ever even use this?
To us, it's just the equivalent of full funnel ROAS, so all revenue divided by spend, and it's just like a different term for the same thing. So marketing efficiency ratio. I think full funnel ROAS is most commonly viewed as all revenue divided by spend, so you get like
Mm-hmm.
your return. Whereas MER is often the percentage of revenue that goes to. So
I
it's
was about to
basically
say in Tribblewell, what Tribblewell defines as MER, it's the inverse, right? It's ad spend divided by net sales. And so it's the percentage of revenue that variable cost represents of
yeah,
revenue.
basically the
It's
same.
one and the same. Yeah. Okay, but I will say, like, in the earlier days of ecom, it did get pretty confusing because when I was scaling Guardian bikes, like 8 years ago, ROAS meant in platform ROAS. And so it was specifically the way I would have defined it 8 years ago was it's the revenue that the platform has attributed directly to the ad spend that you spent on that platform. It has nothing to do with total sales for the Shopify store or whatever sales channel we're talking about. And so that's how it used to be used. And so back then, MER did represent, or what you guys call full funnel ROAS,
Yeah.
MER did represent something different, which was like what the platform is attributing revenue divided by ad spend, attributed revenue divided by ad spend is this. MER is this, all revenue for that sales channel. And so the delta is actually somewhat similar to Amazon's ACOS and TACOS, where ACOS, which I believe stands for advertising cost of sales. ACOS is the attributed revenue that Amazon says was generated by ad spend. It uses those figures, whereas TACOS, which I think is total advertising cost of sales, I think that's what the T is, but it's like MER for Amazon. It's all your revenue, right, is factored into that calculation. And so the delta between the two in the Amazon world 8 years ago used to be called organic. It's just not attributed to ad spend. Organic was put in this massive bucket. But now that we have all these problems with attribution, I think full funnel ROAS probably connects with brand founders more because it's just the more prevalent term. And
Yeah.
so, anyways, anything else you have to say on these before we move on to talking about some margin stuff?
We'll sometimes hear, although less common, the term aMER, and that to us
Oh,
means acquisition MER. So it's basically the
new
equivalent of
customer ROAS, right? Isn't that new customer ROAS?
that is just new customer ROAS. And
Yeah.
yeah, I think that like prior to iOS 14.5, I think it was, some brands were already thinking about measurement more, I'm gonna call it like more kind of full funnel or more holistically outside of just the ad platforms. But I do agree, like as attribution and platform became more problematic, all of these acronyms and terms definitely spread out and became more commonplace.
So actually, we're probably not gonna be able to get to all these terms now that I think about it, which is okay. We'll get as far as we can. I want to talk about when to use them. Some of when to use them may be obvious in the name that Dylan stated, like maybe like new customer ROAS. But like, let me explain to you a mental model that I use. And this is me. I'm definitely trying to oversimplify to get like help brand founders think through the basics of when to use some of these metrics. But you tell me if you agree, Dylan, because I do get this question a lot, which is like, well, how much should I use the in-platform ROAS versus the triple well ROAS versus the MER? And like, well, how much time you got? No, but yeah, like I think it's and this is very general, and I'd love more specific advice from you. I'm like, hey, look, generally in-platform ROAS should be able to help your ad buyer at a more granular level figure out what's performing well and what's not performing well at a more granular ad buying level, right? Don't take that to the bank. It's never going to reconcile to the revenue that's on your P&L. And triple whale may help you if you, depending on, again, which attribution method you use, but if you look at their, deduplicated attribution by ad channel, it helps give you a sense of how everything may be, different ad channels may be contributing to your MER or your full funnel ROAS. It's imperfect, right? And there's different attribution methods that you could use within triple whale to get a sense, but it's directional. Looking at full funnel ROAS, or if you use the term MER, that's for you to measure the connection directly to your P&L, right? Like regardless of what the in-platform is telling you and what a triple whale or the like is telling you, full funnel ROAS and MER remove any question about how ad spend is relating to your P&L. It's not super granular, right? But you triangulate those different perspectives to get a sense of adjustments that you should make. I know that's very general and broad, but do you agree, and what would you add to it?
Yeah, I think like directionally agree. I think if I were to try and simplify into like a hierarchy of metrics, um, assuming that all of these are based with an understanding about what efficiency you're driving, what contribution margin dollar, which we'll get to later. Um, and one caveat, if you're a brand that this is for brands that are mainly growing through paid. If you are a brand that's doing like 20 million a year and you grew not on paid and now you're coming to paid, this probably does not apply to you. But if you are like a paid ads dominant brand, essentially the hierarchy is probably something like new customer ROAS is probably the metric that matters the most. really it's probably new customer contribution margin dollars. But if you understand your gross margin, which we'll get to too, all of a sudden that can become like the North Star metric. And as long as you're hitting target, spend as much as you can, as long as you are still satisfying the contribution margin dollar goal for your business, which sometimes you can't spend an infinite amount because you run out of inventory, or perhaps when you're spending those dollars, you're maybe hurting your either your percentage of contribution margin, which may or may not matter depending on how you set up and how sophisticated you are, or if you're like a business that loses on acquisition but has great LTV, then it can't be. But for like most media buying people, CMO type people, the primary objective is to bring new into the business and then do so at a new customer ROAS outcome that makes economic sense based off of gross margin and LTV. And that's probably the primary metric that most people in your like growth department are looking at, aside from your retention marketers who are trying to grow LTV. But for the sake of these metrics, most of these are more so related to the allocation of ad dollars. So I'd say new customer ROAS is like the king.
Agreed. We'll have to stop it there, even though I have a lot of things to say about that. That's okay. It's okay. It's all connected. Let's talk about margins next. Gross margin. So I want to caveat or say something about this and then let you jump in. So accountants are trained in school and in generally accepted accounting principles, right? Gross margin from a cost standpoint is only supposed to include landed product cost and anything that inbound processing, like so any cost to get it basically put away at the warehouse, right? And in sellable form. Ecom has hijacked this metric for better or for worse. I don't think it's good or bad. It's just to know the difference, right? GAAP gross margin does not include some of the costs that a lot of people include in gross margin in the ecom world. It's GAAP gross margin is net sales, minus landed product cost, which is gross margin dollars or gross profit divided by net sales. Now, ecom has hijacked it and included more into that. Do you want to walk through what you guys include in gross margin, Dylan?
Yeah, so like we would whether it's gross margin, variable cost, it would basically be landed COGS, logistics, and then payment processing would be like your primary variable costs that we're actively looking at. And as we have this conversation, it also like reminds me of like why so many teams who have like non D2C first kind of finance people often struggle to get things like structured properly, is because yes, maybe like maybe you have to partially do it this way, but you also have to analyze this way. And it's like time and time again, these small little changes are actually like the ripple effects they have in how your org makes decisions are so big. So I'd be curious to see how you think about that, Jon, and also just like how common you see this like poorly impact businesses if it's not being properly categorized.
Yeah, I mean, it's a big deal. Funny enough, because I come from the GAAP accounting world originally earlier in my career, and this is how we did it at Guardian Bikes. We don't, gross margin is GAAP gross margin, but we have a third metric. It's not gross margin and then contribution margin. We have one in between those two that we call margin before ads or margin before marketing. And so it doesn't matter what you call it. It just matters that everyone on your team is very clear of what's included in each one of those, right? And so what Dylan is saying, and this is very common, there's nothing wrong with this. Most people in the e-com world, when they say gross margin, they mean revenue minus landed costs, minus shipping and fulfillment, minus credit card fees or merchant fees on Amazon or another platform. That's gross margin. We call that margin before ads, and we do have gross margin with only landed product costs above that. And then we subtract ads to get to contribution margin. So that's kind of defines contribution margin. But to your point, Dylan, so here's what we do different than the typical GAAP P&L is we don't keep shipping and fulfillment and credit card fees as a selling cost further down in OpEx. We have it above the contribution margin line. That's the key, right? And the point is that we talked about this on episode 10, I believe, the last episode, is that we go away from GAAP and we go to what's called a variable costing P&L, which is net sales minus all variable costs equals contribution margin minus all fixed costs equals net income, right? And so it's absolutely critical, no matter where you have it in your chart of accounts, that you're able to easily isolate it and map it, right, for the purpose of analysis above the contribution margin line, because shipping, fulfillment to the customer, and credit card fees are true variable costs that go up and down with sales volume. So you've got to classify it as such. And when you don't, your P&L forecast is wrong. I don't know. It's like that. That's that easy to say. Like it's just wrong. And actually, the most important thing is, I actually just filmed a mini episode about this on the Free to Grow podcast the other day, which is why it's so top of mind for me. Why does this really matter? Right? It doesn't matter because of being a stickler about like where stuff exists on your chart of accounts. It matters because when you're scaling an e-com brand, you're in the game of measuring incremental impact, right? And you're in the game of measuring what? Incremental impact of ad dollars. There's incremental impact of other stuff, but that's the one you're measuring the most frequently. And the whole goal, to Dylan's point, this actually builds on what Dylan was just saying about why new customer ROAS tends to be so important. The whole goal is that as you spend another dollar of ads, right? And over time, on average, you experience the law of diminishing returns on new customer acquisition. You have to be able to measure that contribution margin dollars are still going up on average. If they're not going up, then your P&L incrementally, your bottom line profit is not going up. And so then you have to ask yourself, why am I scaling ad dollars? So that's why this is so important. I'm curious. This is not like, I don't think this is substantively matters, but some people call contribution margin the percentage of revenue, and other people like to call the dollars contribution or contribution profit. I know the actual like traditional accounting terms that they teach you in school, but do you guys consider contribution margin to be dollars or the
Yeah,
percentage of revenue?
most commonly we talk about it in dollars, but in our experience, a lot of brand operators have a target profit percentage that they want to maintain. So often we'll do both. Um, when we're talking about maximizing, like on when we're setting targets, normally we're setting a targets based on a dollar amount, less so a percentage amount. But we'll kind of flip between contribution margin dollars and contribution margin percentage as needed based off of the objectives. I know we chatted about this previously, but like I think that going off of dollars probably makes more sense a lot of the time. The percentage to some degree might matter as well, depending on like your targets and whether you're more so trying to optimize for return on invested capital above all else, versus just like sheer volume of profit dollars. But that's kind of how we think about it. We'll kind of flip between the two as needed.
Yeah. I almost always, no, like I'm starting to form a pretty strong opinion to just use dollars, but it's not because there's necessarily anything wrong with using the percentage, which in traditional like accounting school, it's contribution margin ratios of what that's called, CMR. So contribution margin is dollars, contribution margin ratio is taking those dollars and dividing it by net sales. The reason why I have made it like a requirement more or less for myself and our team at Free to Grow to like focus on dollars is because I started to realize that founders, and then this is okay because I actually have the same problem without like doing the math, have a hard time of translating whether a given percentage is better or not in more absolute dollars terms, right? And they can go like, oh, this revenue, but to protect contribution margin ratio to stay at 20%, actually you just drop it to like 18 with a little more volume and it's a better outcome. It's hard for them to see that without looking at multiple scenarios. And
Yeah.
so I think where it usually manifests itself, though, where we still do help them there, we do still help them manage the efficiency of their balance sheet, right? Because return on invested capital is like it. To do that, you have to combine the balance sheet management, right, back with the P&L. This is why it's so important to have a CFO to not just have a P&L forecast, but to have a 3-statement financial model forecast, which forecasts the balance sheet to say is like, oh, to get this margin dollars, contribution margin dollars, which ultimately yields this profit dollars, right? This is what we have to do on the balance sheet side in terms of buying more inventory or how we finance that inventory purchase. And from looking at the balance sheet forecast and the P&L forecast, we can calculate what you're talking about, return on invested capital, to see how efficiently we're deploying our own capital. So it is, it's not that one of them is better or worse. We've just found that it's easier to get brands to think through whether a higher revenue volume at a lower percentage contribution margin ratio or a lower revenue volume at a higher contribution margin ratio. Like, it's harder to get them to understand than it is to like forecast the dollars and get them to wrap their mind around that.
I think it's also like maybe just a byproduct of our industry being obsessed with like percentages or like multiples.
For sure.
On things. Like it's like ROAS.
Oh yeah, dude, that is like, don't get me started on that. That's a different episode.
And then there's also like we get a lot where like a brand operator will say, I want to have 20% net margins. And it's like, why? And it's probably because a lot of the time someone else they know has 20% net margins and they want to have that because that's what they have and like, it seems safe. But like you might actually make way more money if you have 12% net margins because you're doing way more volume. So
For sure.
I think a lot of it is just built into a lack of understanding of what you're trying to optimize for. And when you're trying to optimize for profit, normally the best way to do that is not on a percentage basis. It's on like an absolute dollar basis. And I also think the percentage thing comes up more because I kind of already said this, but like comps, like you often hear what's like the average GTC brand's net margin. And it's like, well, X percent. It's never X dollars. It's always X percent of this revenue, X percent of this revenue. So I think it's just because it's more commonly talked about. But I agree, both can be used, but ultimately dollars is probably better. I think that's something that I've also learned to appreciate more as we work together more as well.
For sure, for sure. So speaking of dollars, contribution margin dollars, let's talk about new customer contribution margin and returning customer contribution margin. We touched on this, but I just want to clearly define the formula for it, right? Because I recently did a podcast with Chris Lang, who's over at Send Lane, and I talked to him about this. And a light bulb, he said, he's like, dude, this is a light bulb moment for me. I never thought of doing this. And then a guy just DM'd me on LinkedIn, who's a prospect that we've known for a while and has become a friend of Jeff's. He listened to that podcast and he just DM'd me. He's like, dude, I listened to the part where you talked about how you calculate new customer versus returning customer contribution margin. And that was a total unlock. And he had some questions about it because he wanted to start tracking it. So this is something that we track, that you guys track. What's the formula for new customer contribution margin dollars?
If you have a high LTV business, I don't know how you can actually operate without doing this. It's like
no. Once you see it, you can't unsee it.
Yeah,
right. And I'll even say this is, we have all these topics that are gonna come off of this episode that we can't talk about right now. But I would even say I'm starting to see, even if you have a low LTV business, you need to know this because but you need to know this on a per unit basis more than anybody else, because you need to know if the law of diminishing returns or the law of rising CAC as you scale is bringing your new customer contribution margin dollars per order dangerously close to zero. Because the reality is, when you look at the month and you say, hey, I had $100,000 in contribution margin, if you look at it on a per order level over time, you may find that you have some at lower ad spends, right? Higher contribution margin dollars per order blended with lower contribution margin dollars per order as you're scaling ad spend. And so it feels good in combination, like year to date, like when it's all combined. but you don't realize you're getting close to an inflection point where all of a sudden every new customer is going to become unprofitable. So that's my rant. What's the formula? What's the formula and why is it so important?
Yeah, so what we do is basically, well, there's net sales, and then you uh, subtract out your variable costs. So landed COGS, logistics, so shipping, and then payment gateways. And then obviously above net sales, you're also taking into account what you would, returns, et
Yep.
cetera, et cetera. And then that basically gives you contribution margin for first time customers and contribution margin for return customers. And then you have total contribution margin dollars before ad spend. That's the term we use for it. And then you have contribution margin dollars after ad spend. And that's, or like contribution margin pre-fixed costs, however you want to call it. And that's how we break it out. And the reason why it's so important is, to your point, there's the first time customer piece, but also when you start thinking about like acquisition costs to lifetime value, it's all great, but you also have people who may churn and never come back. If you're not breaking out return customer revenue when you're doing these forecasts and having a contribution margin expectation for return customer revenue, you can't actually understand if you're making more contribution margin from your like active customer file over time. And that's like generally for a lot of businesses, like the name of the game. Like that's how you make more money. The most profitable units sold are almost never going to be for most brands the first time customers that you acquire with ads. It's probably going to be the sales that come back organically or from a super high ROI channel like email. So to make sure you're kind of thinking about optimizing for profit over a long period of time, I think this is like absolutely required.
Yeah. So we track this on a monthly basis. And so the difference between new customer contribution margin and returning customer contribution margin is, like, in terms of the formula, is that, like we mentioned earlier, all ad spend gets allocated to new customer gross margin dollars or new customer margin dollars before ads, right? And what's key about this is, one, you have the ability to do it on the order level by dividing it by the number of orders, right? So you can actually see what every customer new, or you can see what new customers and returning customers are contributing to the business on an order level. For us, it's more important to look at new customers on an order level and track that over time as you're increasing ad spend, because you can see the squeeze of the number of margin dollars, right, that new customers are generating as CAC goes up because of diminishing returns. But another way to explain what Dylan was saying is, at some point, you may already be there, you reach an inflection point, we start losing money on new customers. So every per customer contribution margin dollar, or the contribution margin dollars for each new customer, is actually turned negative. But if you have returning customer contribution margin dollars in each month, that overcomes that negative and more, you're generating net positive contribution margin. And we will graph this out over time, and you'll see, this probably isn't going to be very helpful if you're not watching this, but like if your new customer contribution profit is going down and it's turning negative, right? But your returning customer sales or returning customer contribution margin is steeper, right, than that. When you combine them, what effectively you're doing is returning customer contribution margin is going up faster than new customer contribution margin is going down. And so that is what it looks like for a brand that can afford to lose money on new customers. That returning customer contribution margin outpaces the loss every month on new customers. And you can see metrics that are helpful in a cohort analysis, right? But it doesn't show you the absolute contribution margin dollars on a monthly basis to confirm that your returning customer contribution margin is truly outpacing your loss on new customers. And so it's super key to be tracking these. And like Dylan said, I totally agree. Once you see this, you can't unsee this. And it doesn't matter if you're a high LTV or low LTV business. In my opinion, you need to see it in both cases. And you need to make sure that the trends are going in the right direction. And I'll say, Dylan, like, in doing our CFO audits, one of the biggest unlocks, I didn't expect this, but it makes sense in hindsight, is on a monthly basis charting out new customer contribution margin dollars per order. And when you graph that time series out, right? And you see ad spend going up and you just keep seeing that number go down, new customer contribution margin dollars per order, holy crap, at some point this is going to go to zero unless I change something, right? And it's hard to understand that without calculating this metric. So it's like once you see this, you just can't ever unsee it, in my opinion.
Yeah, I agree. I couldn't even imagine running a D2C brand without having this be broken out. It impacts everything. This is talking about contribution margin. It even impacts inventory planning, how you place your
Totally.
bets, like new customers, return customers, they buy different things. Like these things have to be forecasted separately, in my opinion, if you're going to do it at like the highest level.
Okay, 2 more and then we're finished. LTV and CAC. Let's start with maybe arguably the easier one. What does CAC stand for and how is it defined?
Customer acquisition cost. So I think that can again kind of go back to ROAS. You can have all the same things apply. So is it new customer CAC? Is it like that? Traditionally, it would be new customer CAC, obviously. And then you have your in platform, your third party reporting. Some people call it CPA, so cost per acquisition. And then you just want to make sure that when you're using those terms, you're associating with like which CAC you're referring to.
For sure.
Make sure you're making it clear between platform, full funnel, where it's just all like based off of the number of new customers you acquire in relation to ad spend, et cetera, and in platform two or in these third-party tools, which attribution setting you're using.
Yeah, so it's basically ad spend in whatever segment or whatever platform location that it's ad spend divided by new customers, right? So it's basically, if you think about it, it's the dollars of ad spend per new customer acquired, right? And so we can talk about in a second when to use this, but that's key. So let's talk about LTV next. What's your definition of LTV?
So we talked about this earlier, but like giving a time window. So what time window are you referring to? I think a lot of people think about like CAC paybacks. So what you would do for this is instead of doing LTV, you'd actually do lifetime contribution margin. So like the contribution margin dollars per cohort as people come back. So you look at like what's your average contribution margin dollars from return customers, and then overlay that with the value increase over time. So you can basically say at $50 of CAC and I lose money at acquisition, I get paid back in month 3. And I think a lot of people have varying opinions on how fast you need that payback to happen. The reality is it just depends on, what the real long-term value and the stickiness of your customers are and your present financial situation. But traditionally, for most brands, when they're talking about LTV, they're time stamping it, and it's often going to be like 3, 6, 9, 12 months. Usually, when you're making decisions on acquisition, you're not extending your assumptions beyond 12 months. Usually, most brands, I think, are looking for like 3 to 6 month CAC paybacks. But some brands need to be very first order profitable, and some brands can stretch things pretty crazy depending on how sticky their customers are. So to kind of stop over answering the question, the time
Over answering, man.
Typical.
Asking a marketer their opinion about LTV. So a couple things to add. We just tell our clients LTV is measured in contribution margin dollars or margin dollars before ads. LTV should be measured in contribution margin before ads. Some people will say in gross margin dollars, depending on which way you define those things. But we always say, pull up a cohort analysis and whatever, Lifetimely, Triple Whale, Shopify. It's not LTV, that's LTR, lifetime revenue, right? Call it what it is, lifetime revenue, just to make it clear. So, and the reason we say that is because if lifetime value is the amount of value that a customer is for your business over time, well, the revenue is not the value to you. You don't keep the revenue, right? You keep the revenue minus the variable expenses, minus the ad costs. So we need to measure it as such. The lifetime value, the LTV to CAC analysis that we do, same thing as Dylan, I'm just explaining it in our terms, is we restate the LTR, lifetime revenue cohort data in whatever platform we get it from in margin before ads dollars, right? and we line up the CAC for that cohort down we create a new first column, and that's the first thing there. And then we can run conditional formatting to say, basically, once you have accumulated more margin dollars than CAC, that cohort pays for itself, right? And anything beyond that, if you keep accumulating margin dollars, it's generating profitability for that cohort above and beyond the CAC.
I've got a fun question. I know we gotta wrap up, but what is like the longest like CAC payback you've ever seen that was actually still like a viable good business in D2C?
Well, well, viable and good is maybe subjective.
Yeah,
But we actually, so there's
no,
actually an example. We actually had a training, an internal training about this with the team a couple months ago. We do these trainings where we bring up a topic like this. We do a quick kind of like training on the concepts to make sure everyone has an even playing field of how we're defining things, and then we let people just jump in and like share opinions, share stories, debate things. And one of our CFOs was like, "Hey, I don't agree with you, Jon," which is great. It was great, like healthy debate. She's like, "Jon, I don't agree with you that like a brand should probably," I said probably, "pay back their CAC um within 6-ish months or so, plus or minus." She said, "Because I have a client that like they're okay with a 12-month payback, but this brand is backed by a PE firm, and they have decided as a leadership team that they're willing to plug the gap with equity dollars because they have their sights on a strategic acquirer that's they think is going to buy the business even if it's not profitable. So the brand's not profitable. They're teetering around break even, but they were okay with a 12-month payback. You know, if you have other incentives or that's not a common case. Most brands need to be profitable. If you're bootstrapped or you're self-funded, right, and you're not going and raising equity on a continuous basis, generally I see that CAC needs to be paid back by LTV in 6 plus or minus months. Plus or minus meaning it depends on multiple different factors. Quite frankly, too, and I've learned a lot of this from you guys, it depends on how fast you're scaling ad spend. Because really, the speed at which LTV pays back the CAC is kind of it's related to how deep of a hole did you put yourself in that first month. You could put yourself in a small hole, right? And be willing to not go any further. And it's a very small new customer margin dollar loss. But you could put yourself in a deep hole, and the deep hole generally needs to be paid back faster because you got to plug the gap of this deep hole, right? And so the speed which of scaling drives how deep that hole is in month 0 or in your first month. And so I think that's a big contributor as well.
And like the speed at which you return customer revenue compounds essentially puts the cap at how fast you can scale, unless you have a way to fund it that is viable. But eventually it usually will. I think that makes sense. That's similar to my experience. I guess like if you do have an like crazy above average like year 1 plus LTV where your cohorts just keep compounding like crazy. But in my experience, it's often like you're looking at like 6, 7, 8 months CAC payback. Anything beyond that, it starts to get like rare that it works. Even at 6, 7, 8 months, I'd actually say that's rare. That's just like in my experience where I've seen it stretched, I think, to the highest extent. Oftentimes, most brands are looking at like 3, 4, 5 when they're losing an acquisition. But I think for most brands, they actually have to just be first order profitable. You're normally an exception, even if you do have the ability to acquire at a sizable loss like that. So largely the same experience on my side.
All right, man. This is a great discussion. So in summary, we went through some of the most common ecom metrics. We talked about how to define them, right? And when to use them. The key is you as a brand, you make your decision like on what you're going to define these different terms as and get your whole team on the same page. That's the most important thing, so that there's no lack of clarity when you're using these terms. Doesn't matter if you use full funnel ROAS or you use MER, just be super clear and make sure everyone's on the same page. So you guys are talking about the same concepts and dynamics when you use these to make decisions. But think that's a wrap.
Yes, sir.
Let's go.
Let's go.